I'm good.
Thanks for.
Are we getting any feedback here, or I just want
No,
to make sure.
not anymore. I was hearing an echo before. Maybe you
Okay.
had the volume on in the LAR room, but it's fine now. So, welcome back. Great day for you to be here. One day ahead of the ECB. Have caught a few of your appearances on CNBC. You were growling like a grizzly bear on one of the occasions, saying this is the year to sell rallies. Believe you're referring to the S&Ps. What's your
Yes.
view on what could happen tomorrow, and how are you looking to make it actionable after the ECB and the Draghi press conference, buddy?
You know, the ECB is going to be a tough call because so much is already expected. I mean, the market is looking for a negative cut to around 40 basis points. The really open question is, are they going to do QE? I don't think actually they're going to do QE. There's a lot of institutional resistance to just kind of pump out money into the system. But having said this, though, hey, Del, are you there? Okay. Um, Having said, so let's say they don't do QE, and then you have a knee-jerk bounce in the euro to 110, 110.50. I'm still very much long-term bearish euro for a whole host
Okay.
of reasons. So, if we get a bounce off of the euro yesterday, tomorrow on any kind of presumed upside surprise in ECB, it's just going to be a better opportunity to short it around these levels. I like shorting it around these levels on a long term trade. Anywhere above 110, I think is going to be a great short here for the rest of the year, because I do think there is not an insignificant chance that we certainly can get down to 105s, and there's a possibility that we can go down to parity for a whole bunch of reasons. Um,
Okay.
if you want me to
So,
go, yeah, go
okay,
ahead.
yeah, let's hear the laundry list.
Well, so the most obvious laundry list is just interest rate. Um, that's the word I'm looking for. Um, Mispricing. Um, Given where U.S. rates are, given where European rates are, the euro should be much, much lower. The only thing that's keeping it up, I think, in many ways, is markets' negative view of the Fed, that the Fed is just not going to hike rates. That they sort of paused on the hiking rating scale, and two, that Europe still sports a very, very positive capital account. The Germans continue to basically export their way out of trouble, but I think that piece of it is going to become more and more problematic, because Germany's biggest export markets were China and the Middle East. Aside from us, I mean, they'll keep exporting to us, but that alone is not going to make up the whole juggernaut that they are used to. So the Middle East is
Well,
dead. Uh,
weaker demand coming out of China and
yeah,
the Middle East with low crude prices up until recently, some stability there.
yeah,
Not the same type of buying power for European goods.
no, and I think you're going to see month on month, quarter on quarter slowdown. So their capital position is going to get eroded. Um, the other big thing to watch, to me, the weakness in the euro is really Germany. Everybody else around Germany is a basket case. Italy literally is a basket case at this point. Everybody keeps listening. If you're listening to Squawk every morning, that Italian banks are limit down, limit down, limit down, and we're all ignoring the fact that basically the Italian banks are literally bankrupt. Now, Italy is no Greece. Italy is the third largest economy in the eurozone, 125% or 130% of GDP. $5 of every dollar that they raise in taxes goes to nothing more than just paying interest. Um, to me, Italy is teetering on the edge of collapse, and if Italy goes as a sort of a black swan event, it's a very, very negative event for Europe. But the fundamental thing to keep an eye on is just the slowdown in German activity, German industrial production, and factory orders, unemployment. You start to see German unemployment start to pick up. All those things are going to force the ECB to become a lot more aggressive. The ECB basically acts at the behest of Germany. If the Germans don't want to do something, it's really hard for Mario Draghi to get it done. But the moment they get into a weakened position, they're always, let's print money. So I think for all those factors, you have a preponderance of risks to the downside in the euro. Fundamentally it's one of the cleaner trades that you have. And then if is that the euro chart you have up right now? What are we looking at right now? No, it's not. You're looking
Yeah,
at
that's a 4-hour euro.
Really? No, it looks like pound right now, or is am
No,
I losing the pound quote or is that the
no,
euro?
yeah, it's 109.76 last 4-hour euro chart.
So let's just pull up the dailies. Just let's go up a little bit wide.
You got it.
So the thing with the dailies that I think is interesting is that if we start failing of it, there's no doubt this 108 is a really strong support level, and it would take quite a lot for it to break it. If we break 108, it really puts us on path up to 105 quite easily. But if you look from the top side, what you see here on the top side is a failure at lower highs continuously, right? We failed over here at what is that? That's like 115. We fail at around 113, and if we fail over here, if this is sort of the intermediate term high here, the sequence of lower highs really gives you a lot of confidence that the bearish trend stays in place. So to me, unless the euro starts to take out 13, 1400, and then this whole thing turns itself around to kind of a bullish posture because you have higher lows, you gotta just sell the rallies here in many ways. It's
Okay. Okay. So to me, it looks like, and I could see, we had that peak at 117, we had another peak at 114. That so far we've retraced from the 108 level, maybe about 38, not even halfway back yet. So we could even get a move to 111, 112, and that would be a shorting opportunity, wrong over 114. And then back under 105, back under 108. Basically that was close to a 500 pip break from the near 114. That could take us down to your 105, 103 level.
Yeah, it does. Yeah, exactly.
Okay.
Then everybody starts talking about parity, and you may get just momentum down to parity. But I think it's reasonable to target 105 as a longer term target for this year.
Do you think it's possible? I know the Germans have been against, like you said early in the interview, about QE and just throwing money at the problem. But the fact that Deutsche Bank retested, even took out the 2008 lows, may change their mind.
And I haven't even started throwing that whole mess into the equation, because Deutsche Bank basically has $75 trillion worth of debt, of derivatives on its books. Now, yeah, they're notional and they're offset against other counterparties, but if some of those counterparties are weak, even if some of those counterparties are Chinese, you really don't know. If some of those counterparties are Italian, there's 100 different ways you could slice that apple in a very, very ugly fashion. So Deutsche Bank to me is a problem that's just not going to go away. There's just they have too many debt outstanding. I'm sure they're desperately trying to paper over a lot of their stuff. I'm sure they're trying to dump as much of the derivative garbage that's on their books as possible. But at the same time, you have a $75 trillion book. Nobody on the street is going to take that off your hands. And that creates, I think, even more problems. And they are effectively, as far as their balance sheet goes, really undercapitalized. So that's a very, it's a dangerous position to be in as well. So yeah,
go ahead.
No, go ahead. I'm done.
Okay. Perhaps we could switch gears. We've had recoveries in commodities. I'm looking at the Aussie. It's had a great run, but to me it looks like this run might be close to running its course. Here's your daily. You had your breakout at 72.5, and the measure is maybe 77. You have a different view on the commodity currencies. Crude broke yesterday. Canada held major support at 32. Do you think that commodity currencies can pull back if this commodity rally falters?
Yeah.
Or do you think crude is bottom?
Hard to say. It's
There's a lot of that going on today for me. Hard to say.
Yeah, it was definitely hard to say. Do you want to get in front of Aussie right now? It could be a great trade, but you got to be willing to hold till 77.50. It's a big short. We're short Aussie on a long-term basis because I think China collapses and Aussie goes back down to 70. I also, I don't think the RBA is going to like seeing Aussie 75, 76 because whatever rebalancing they've had. This, and I generally think that basically Australia is another head fake. They had rebalancing. Their consumer and services sector is definitely doing better than you would be led to believe, given the fact that they've just had a collapse of all of their demand. Iron ore prices have gone through the roof over the last couple of days, but all of that is a function of the fact that the Chinese were simply incredibly short supplies into the Chinese New Year. That it's all seasonal. There is no organic demand. They're not building any more frigging buildings in China. They're not building any more frigging highways in China. They have overbuilt themselves probably for the next 10 to 20 years. Completely overcapacitized themselves. And that just tells me that the demand for Australian commodities is going to taper off significantly. That leads ultimately to layoffs and bankruptcies. We haven't seen that. We haven't, they've been able to escape the bankruptcy issue, and the jobs numbers have finally just started to crack this month. We have 2 or 3 months of negative job numbers. All of a sudden, you're not going to hear the RBA singing the neutrality tune. They're going to start thinking about lowering rates. That's going to take Aussie right back down, I think, towards the 70 mark. But it could, in the meantime, the short squeezes can be pretty brutal. So yeah, I mean, the chart basically tells you 70, 75 to 77 is the next resist zone. Shorting against that position makes a lot of sense, but it could be a lot of pain for sure.
How about Canada? We've had a nice bounce off this 32.5 level. BOC left rates unchanged. We're getting a pullback. Is this a break to buy in Canada? We had about a 200 pip pop. What do you think?
And again, it's one of those things where Canada could break 30 before it finally bottoms out. In other words, oil, it feels now. I said this the other day actually on CNBC that rarely do you have V-shaped recoveries in commodities, right? Unless you have a supply misadjustments, right? In other words, you have massive undersupply, then massive oversupply, and and things go back and forth. But I had forgotten really a very important point, which is that commodities have nothing to do with commodity. They have nothing to do with supply and demand, especially oil. Oil has nothing to do with supply and demand of oil. It has everything to do with speculation. What do we trade? We trade about 1,000% more of paper than the actual underlying commodity at this point, maybe even 2,000%, meaning that for every real barrel of oil, we trade 20 times more paper. So
good point.
When you view oil the same way you view the euro, the same way you view the S&P 500, that is a financial product completely divorced from any reality, right? Then you have to trade sentiment, and we all know that sentiment is much more V-shaped, right? So can we squeeze out to 40 in crude? Yeah, I mean we could. I do think that the real money will probably going to come in and be happy to dump whatever they can at 40 on the market. But if we take ourselves up to 40, the dollar Canada can go down to $1.30.
Yeah, it could.
So again, I think the way to trade all of these things, if you're on the opposite side of them, in other words, if you think that these are exhaustible moves.
Well, I think we could go to 130, but I think we could get back to 136 to 139 first.
Well, what I'm saying is, since it's so volatile and it's so hard to trade the commodity currencies, given the volatility of the underlying assets, the only way to do this reasonably is very small size, scale down. So in other words, you put your toe in the water here at 32.50. You come in at 31. You come in at 30.50. You come in at 30, and then you put a hard stop right at around 28 or 28.50. If you're at 28.50, so you're just completely misdiagnosed the issue. But that requires lots of small entries, lots of pain absorption, and a lot of patience to have the whole thing turn around. Because do
you do that on a lot of positions, Boris, where I'm a big believer in reduced leverage. One of my expressions is, if you can't be wrong for a day, how can you be right for a week? And the way to be able to, the way to withstand algos and black boxes is to dramatically reduce your leverage, so your stops are wider, and you build a position.
Yeah, I mean, I wholeheartedly agree with your philosophy. I don't trade long term, but I do practice the exact same thing that you preach on a shorter term basis. Um, and we day trade all day long, and my sort of target is 10 to 15 pips per trade. We try and do 5 to 10 trades a day, but every single trade that I do is never more than cash on cash, meaning one-time equity, right? So
Okay. Yeah.
if I'm doing 10 trades, first of all, I'm never going to have more than 2 or 3 trades in the market at the same time, but
Uh-huh.
that means that my maximum sort of lever exposure is 3 times equity. So you're absolutely right. If you can't be wrong, I guess the way I would translate it in my world is if you can't be wrong for an hour, then how can you be right for a day, right?
Yeah, I like that. Okay. All right. So I know that from what I heard on CNBC that you think this is a year for selling rallies in S&Ps. So I guess a linchpin would be U.S. dollar yen. I'll put up the daily. We had this double bottom at 111.
Yeah.
Everyone's looking to get short at 116. That was a breakdown of U.S. dollar yen. And one thing that bothers me, and I'd like to be short for the next wave down in S&Ps, Boris, but the whole world wants to sell this rally up here. Even if we go to 2030, 2020, 2040, SPX, because they missed it in January. Okay, so they missed it in January. Now they're licking their chops and going, "Wow, this could be a secondary top. It could be a failing rally." Do you think there's a possibility, knowing how Mr. Market is so mean and doesn't want to accommodate
No, no,
hardly anybody, that
yeah,
we print a new high in the S&Ps and shake out every bear
absolutely.
before we have a break?
Well, before we have a break, that then just takes out everything you've earned that whole year. Right.
Yeah,
I mean, I think that could very well be the story this year is that we do spike ourselves up to a fresh high. Everybody and their mother gets on the bull train wagon, even though it's 8 years old and it's older than most of the Social Security recipients, and
yeah.
um, um, and at that point the rug is pulled underneath everybody.
Okay, so that would imply, here's what I think. Everyone's looking at the weekly chart. I'll put it up on the end. We have that breakdown at the 116 level, straight line, breakdown, your neckline, whatever you want to call it. And in my experience, when everyone's looking for one number, it either doesn't get there, or if it gets there, it's like a hot knife through butter, where we could have a rally back towards 118, 119, 120, and that would most likely, since the U.S. dollar yen hasn't done much off the low, if we had a rally back up towards there, that might sow the seeds for over 2100 in the S&P. What do you think?
It's possible. It's definitely possible. I mean, I think the problem is that these are very long-term prognostications that are just impossible to make at this point. All you can say right now on dollar yen is we're holding bid, right? I mean, we're holding this 111, 112, and if you're positioning for some kind of a bull move to the upside, you got really great risk-reward parameters here. You got a decent technical structure. And you want to you want to buy every dip. We've been trying to buy the dip. We got stung a little bit. We bought it too. We did well. Yes, last week Kathy bought too early. Now we're sitting here floating this thing, but it's finally moving our way, back out. I think the universal rule this year is whatever it's like the rule about business, right? You're looking to start a business and you have a certain budget, and they always tell you double your budget and double your time for when you think it's going to be real, and that's probably like the best realistic case you have. So same thing with trading. You have a thematic view one way or the other. Double your stop and double your time and half your position, and you may be able to survive your thesis properly. It's just that kind of environment in the marketplace. You have to have a large margin of error here to succeed this year, I think.
Okay, and what changes? Because, I mean, volatility levels don't seem to be that much greater than they've been in past years. Is it
Deceptive.
just...
It's deceptive because what happens is look at the yen. You have like nothing, 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 and then you
True.
have boom, 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 boom. Literally, 3, 4. I
True.
mean, yen did 800 points in 7 days. It hasn't done 800 points in 7 months.
Good point. So when you look at the yen, you have that. You look at the euro, you don't have that.
Yeah.
You had it in cable. What's your view on Brexit, buddy?
Oh, we've been going back and forth in my chat room on this all day long. Actually, I don't know if you saw my tweet. I had this thought this morning that, is the Trump phenomena the same thing as the Brexit phenomena? And I think it's kind of true in a sense that both political positions from a rational point of view are utterly idiotic. I don't, you can argue with me all till blue, till you're blue in the face, but there is no good reason for why UK should leave the EU. There's really no good reason for why Trump should be president. But here's the big but. They are speaking to the populist idea. People are tired with institutional malaise. People are really, really tired with failed, corrupt politicians. And it's kind of like throwing the baby out with the bathwater, or just
it's kind of like the 30s, where you have the right and the left rising.
Right.
Because people are angry. Didn't Shakespeare say, when the coffers are full, people want a democracy, and when they're empty, they want a dictator strongman?
If he said that, that was probably one of his better, more astute political points. But I think that's what it is. I think people are just you have this really serious frustration, and arguing reason.
Are you angry? Are you angry about people being angry, Boris?
No, I mean, I understand it. I mean, I understand I totally understand people's frustration. I really appreciate all of my UK members and it's kind of my group is kind of very split between those that think it's the stupidest thing in the world to those think that it's the biggest, the smartest thing in the world, to leave EU. But I do see their point of view. They're paying all these taxes. They have faceless bureaucrats out of Brussels, telling them what to do. It's what you're seeing, unfortunately, and this is sort of we're coming to the cusp. What I think is a very dangerous time in Western democracy. Period. We've had this since the breakdown of the Berlin Wall. We've had a tremendously positive, virtuous cycle of unification, right? Unification of culture, unification of economies, unification of mores, which allowed a guy from Belgium to travel to Spain and a guy from Spain to sell his services in UK, and essentially Europe to become a mini America, and Europe and America start to trade with each other much more, and it's just this whole amalgam of unification. Basically, everybody becomes the same, right? So that's a great thing, because everybody becomes the same. We all have the same laws. We treat each other nicely. Nobody fights with each other. The argument is that no country that has McDonald's ever went to war with each other. I think it's actually a bullshit argument. But the point is, it's much, much better. But the flip side of it is everybody has to give up their individuality and their culture. And I think what you're seeing here is this incredible anger at the fact that your individuality is subsumed towards the greater good of society. That's a universal conflict we've had in the history of mankind, and it always ends badly, because the desire to express your own individuality usually ends in fascism, and and I really hope we don't go that way. But
okay, so talking about history, historical money is shiny and yellow or silver. So I put up the gold chart here. Druckenmiller's looking for 1,400. Goldman's saying yesterday and have reiterated there's still negative gold in the metals and commodities. What do you think of gold in here, Boris?
Gold is my number 2 strongest thesis. I like gold. I think gold, and I'm not hardly a gold bug, but I think what changed this year that is a fundamentally positive driver for gold.
Negative rates.
Negative rates. Negative rates. You got it.
Yeah, because you and I are from the old school, and the bear argument all these years was opportunity costs, no yield on gold. You have to pay for storage. So negative rates eliminates that opportunity cost.
But yeah, not only does it eliminate it, it actually makes it highly competitive against cash. What is your opportunity cost if you're in a Swiss franc? drop 1,000 Swiss francs into your bank account, you get 990 francs back at the end of the year. You do that for 10 years, suddenly your 1,000 is worth 900. You haven't done a blessed thing. At least gold, you hope that 1,000 is worth 1,000, that it was before. And I think the flip side of it is, of course, the 1,000 is worth 2,000 because everybody is doing the same trade, which is I don't want to be in cash, I want to be in gold because gold is the new cash. So I like gold. We have a long-term bull spread on gold, and that's my number. My euro short, gold long is my two top trades for this year. Let's see if I'm right.
Okay.
But,
interesting. So what do you think for the Fed next week, Boris? And do you think there's a chance that the U.S. also, in desperation, moves to negative rates, or
no,
is it possible?
it's way too early. First of all, labor markets are pretty decent still, right? I mean, we are kind of hanging. Labor markets are pretty decent. The Fed is certainly not going to go negative or even cut rates. The Fed is going to stay stationary, and they're going to play footsie with the market. They're going to say, hey, we're going to think about possibly hiking rates because things are not as bad as everybody thinks, and we don't give a shit because we're an island nation. And, we're not as affected by China and Europe and everybody else, and here things are pretty good, and we're going to just create a monetary policy for U.S., not for the rest of the world. This is just all propaganda to keep the market believing that there's a potential for a rate hike. Basically keep rates relatively tight. They really don't want to see deflation. They don't want to see European deflation, imported here. So they got to play footsie with the market and try to BS us into believing that they're going to hike rates. But no, I don't think they're going to hike rates. I think they're going to stay stationary and hope and pray that China stabilizes, that oil kind of basically maybe crawls itself back up to 40, so they don't have any bankruptcies across the oil patch. And we chug along at 150,000 jobs per month. If they could get that, then they maybe they breathe a sigh of relief. Although here's the thing, how much time do they have left? If they would they be so politically tone deaf as to raise rates in September? I don't think so, right? They'd
have to go if they're going to do it. They have to go in June, don't you think?
Right, they have to go in June. And even if they go in June,
the S&Ps are above, and if the S&Ps are above 2,100 going into the meeting, that would give them cover, wouldn't it?
Even if they go in June, right, and then the economy starts to tailspin for whatever reason, and summertime is always kind of a tough time in the financial markets, right? And we come into September, and it freaking the market is down 2,000 points. Dow's down 2,000 points, the S&P down 200 points, and the Fed had just hiked in June. How much heat are they going to get from the Democrats that they're basically giving the election to Trump? I think there are extraneous factors that affect the Fed. People never look at them. People always underestimate the political variables that underline monetary policy, and I think those variables are going to just become a lot stronger. So the chances of a Fed hike, I think, are smaller than people think.
Yeah, for political reasons.
Yeah.
Into an election year. Although Greenspan tightened into an election year that knocked the first George Bush out of the box.
Right. And you think Yellen doesn't know that model, and you don't think they're going to be really cognizant of that, and I think first of all, I really think they're petrified. I mean, maybe they're not. I mean, I don't know, but I really do think that almost everybody on the Fed board is scared witless of a Trump presidency. So I don't think they want to do anything that would create that.
Does Sanders have any shot, or does Hillary have it locked up in your view?
No, I don't think she has it locked up. The problem with Sanders is the strongest candidate of the Democrats have running, period. Sanders beats Trump by double digits. Sanders is the single best candidate, period, in the whole field. He has the highest likability numbers and everything else. The problem with Sanders is his economic plan really is unrealistic. I mean, $15 trillion worth of taxes. If you look at his tax rates, they look good on paper because it looks like he's raising taxes on very rich people, but he's actually raising taxes on what I would call the top 20% truly upper. In New York City, $250,000 is, I know it sounds insane, but $250,000 buys you a studio apartment. You just can't. In San Francisco, the same thing. There are pockets in this country where $250,000 is just enough to get by. I know that sounds insane to everybody else, but that 10% of the population for whom $250,000 is just to get by is also the most productive part of the population in terms of the GDP growth. So his tax tables have to be completely redone. My frustration with Sanders is if he changes his policy and says, I'm not going to raise taxes too much. I am going to raise taxes, let's say, on $5 million and up, but I'm going to take all the money from defense and put all that money into healthcare. In other words, there's no reason for why Americans have to pay $1 more to get a lot more for their money. We could cut the defense budget by literally 50%, and nobody would care. Because the interesting thing I think about politically this year is that neither the right nor the left want to go anywhere. Nobody wants a war anywhere. We don't care. We want to go back to being an island nation with 20 zillion nukes. You want to come to us, we'll nuke the crap out of you. Otherwise, we're not going anywhere. Why do we need $1.5 trillion worth of defense? We don't.
Well, I would say that the Chinese and the Iranians firing missiles after, and the Koreans, and definitely understand that we're moving towards an isolationist policy, don't you think?
Yeah. And honestly, who cares? The Chinese, they got 20 years to catch up. The Chinese are going to be basically bankrupt whether we do anything on the defense side or not, because they got a lot more economic problems, on their side. We have a big enough Navy, big enough a nuclear arsenal, big enough everything to project ourselves. We basically can just drone ourselves into complete defense at half the cost. So if you take $500 billion out of defense and turn it and create a healthcare system without raising anybody's taxes, you have a winning platform on both left and right. If Sanders is smart enough to figure that out, he has a real chance. If he's not, then we're stuck with the clown show.
Okay, well, I'd like to wrap it with a question that I get a lot, and I ask other people a lot, and you brought it up that you need 100, 200 grand just to be middle class in New York, or lower middle class in San Diego or San Francisco. And people say to me, Dale, could I trade for a living with $10K? And I say yes, if you want to live beneath an underpass. What do you say? What do you say, buddy, when people ask you that? A lot of people turn to trading because perhaps their other occupation went away and they're looking to replace it through trading. I also tell people it's always better to have more than one income stream, because if trading is your only income stream, it puts that much more pressure on you to perform, and we all have drawdowns. What do you tell people, and I'm sure you get asked that question, how much do I need to trade for a living?
Yeah, 100%. 100% on your page. It is better to work the night shift at McDonald's or to work the day. The great thing about trading, by the way, right, especially us in the FX market, is that we don't have to. We can hold a job and trade completely cleanly. You can trade Asia, Europe if you want to do a day job. You can trade U.S. if you want to do a night job. It is much better to work a shift at McDonald's and know that you have $400 worth of whatever income coming in every single week, or whatever the hell you do. I'm just
yeah. I even use rich people's example. For example, Richard Dennis, who was a legend. He also had CME Commodities, which threw off plenty of cash for clearing floor traders. So even the rich know that you need to not just depend upon your trading income.
Listen, almost every trader I know, when they get smart, set up a brokerage house, either internally or externally. And why do you think they set up a brokerage house? Because they want non-volatile commission income. They want non-volatile income. Everybody wants. The key thing with trading is that you need non-volatile income. Non-volatile income means that as long as you show up for work, rain, snow, or shine, you get paid. That's not the case with the market. The market doesn't care whether you show up for work or not show up for work. You don't get paid. Okay, you don't get paid for punching the clock. You get paid for being right.
You also have deductions from your paycheck in trading. Big deductions at times.
That's what I'm saying. You know, none of you not get paid, but you get punished. So you need. I really do think you're absolutely right that you need some sort of a ancillary stream that is non-market volatile. It will make your job a lot easier. And the point is that, you know, I think what happens is people always think that they need to make all their money today, right?
Yes.
So one of the things that we sort of do in our room, and this is the exercise that we constantly follow, is let me just make sure I just get the numbers correctly. Hold on, 4 times 12. Yeah. Okay. So if you want to make 10 times your money, right?
Yeah.
You're never going to make 10 times your money just, you know, by have a hunch, better buy. I mean, you could take 10,000, make 100,000 on one great euro trade, but I guarantee you that the next euro trade you make, you're going to lose it all back and more so, right? Have a hunch, bet a bunch is never a good strategy, you know, to make 10 times your money. But you could make 10 times your money over 5 years. 5 years. If you compound it at around 40% a year. Now, 40% a year is an incredibly hard number to get. But
people, hedge fund managers last year did a cartwheel doing 10-15%.
Exactly. But at 40% a year, that breaks down to essentially 50 basis points, 40 basis points a week, right? That's what we focus on. I mean, we focus every single day, every single week on tiny amount of money that adds up week in, week out, week in. The irony of the whole thing is that everybody comes in for a lottery paycheck, and the reality of trading is it's just a job like any other job where you collect your paychecks and you slowly stack them up over a long period of time. The way people get rich for real is by compounding slowly. You know,
Great point. That's a pearl. Compound slowly.
Yeah.
That's going to be in the report. I want to thank you again. It's always great talking to you, Boris. And again, everyone, you know, Boris and I share the same birthday. So we're both schizophrenic. You know, we both have multiple personalities. Do you have a dual personality, Boris? Have you noticed that there's more than one side of you, and do you take medication for it?
No, I have unfortunately never had to take medication. the older I get, the more I've been able to temper my evil twin personality. I've managed to really control my what my kids say. You only have two. My kids always say I only have two buttons: normal and nuclear. So you know, I don't.
Oh man, that's great, Boris. Great to have you here again today, Boris. Thanks for a lot of great insights and views on the markets. And if I don't talk to you by May 27th, happy birthday, buddy.
You too, my friend. Thank you so much for having me. Great to be with you guys. Everybody enjoy, and happy trading to everybody.
And can follow you at FX Flow on Twitter, and your website is at bkssetmanagement.com.
Actually, it's BK4X, bk4x.com.
bk4x.com to follow Boris and Kathy, the dynamic duo in the FX world.
Thanks a lot.
Thank you, buddy.
Bye-bye.
All right, man. See ya. Everyone.